It's easy to feel stuck when it comes to estate planning. Like you're one wrong decision away from messing everything up, or worse, leaving your family with a mess to clean up. Welcome back to another episode of the Vital Wealth Strategies podcast. I'm your host, Patrick Lonergan. And today we're diving into one of the most important and most overlooked wealth strategies out there, trusts. And I've got the perfect guest to walk us through it. Joining me is Anthony Joffe, chairman of Sterling Trustees, one of the top independent corporate trustees in the country, based out of South Dakota, widely considered the best jurisdiction for trust planning. Antony's been in the trust world for nearly 2 decades, and in this episode, he shares what families are doing to protect their wealth, reduce taxes, avoid unnecessary drama, and pass their legacy down with clarity and confidence. We get into why so many successful entrepreneurs delay estate planning, what makes South Dakota such a powerful legal base for trust, how to avoid costly trustee mistakes, and why a properly structured trust isn't just for your heirs, it's a game-changing business strategy. If you want to keep more of what you built, shield your assets from lawsuits and estate taxes, as well as create a structure that supports your family's values for generations, this is the episode to stick around for. And if you're ready to take action on what you learned here, we've got more tools and resources waiting for you over at vitalstrategies.com/tax. Check it out. All right, now let's jump in. I'm excited about this conversation today. We've got Anthony Joffe, who's the chairman of Sterling Trustees, who's an independent corporate trustee chartered out of Sioux Falls, South Dakota. And they work with high net worth and ultra high net worth families from around the world. So Antony, thank you very much for joining us here today.
Thanks for having me on.
Yeah, I'm excited about this because I think the conversation about trust and estate planning is, it must be scary to people out there because it's shocking the number of clients and people that we come across that have net worths approaching 9 digits and they still haven't done anything with their estate planning yet. And I think they're concerned about making mistakes. I don't want to screw this up. It can also feel overwhelming, everything from I've got to make all of these decisions. I don't know what to do. And so they default to nothing. And then I think there's also maybe a philosophical problem around, I'm going to create this thing. I may not be able to change it. How do I put the right people in place so, the financial industry doesn't just sort of bleed my assets dry and unfair fees and that type of thing. So I'm excited about getting into all of that. If it's okay, can you give us a little bit of your background and how you ended up at Sterling?
Yeah, sure. So I've been in the trust industry for, 17 plus years. Really got in, my dad and I started the business. He was a practicing trust and estates attorney, and he had an idea to start a South Dakota charter trust company because he had a number of clients that were where he was the independent trustee and wanted to make sure that they were taken care of long-term, and had the idea. My background, I'm a CPA by training, worked at one of the big 6 for 2 years, and then spent about 17 years in investment banking. And I guess my dad called me at the end of 2007. It seemed like a good time to get out of the investment banking world into a more recurring revenue business. And I joined him, and here we are 17 years later. We haven't killed each other yet, but it's the business has been, it's a very interesting business. You meet a lot of interesting people and try to solve a lot of interesting problems. And, I tell people that I'm a high-priced psychiatrist.
Yeah, I love it. And the thing that I love about trust in general is they are so flexible in so many different ways. But I think some of those flexibility and decision points can cause people some issues with really getting started and figuring out where to go. So this is all great. I love your expertise. You touched on South Dakota for a second. I think South Dakota is sort of establishing itself as the place to really create trust. And I think that's for a number of reasons. But can you give us the highlights as to why South Dakota is the place to really consider when we're
Sure.
starting our trust?
Yeah, really from a trust law perspective, really sort of the big advantages are there's no state income tax, capital gains tax, no rule against perpetuities, which means you can have a trust that goes on forever. So for wealthy families that, they've accumulated wealth, this will last them for multiple generations, and potentially eliminate GST tax, which is generation skipping tax. They've got the directed trust statutes, which allows you to sort of trifurcate the role of the trustee and give families a little more control over their trust long term by appointing a distribution advisor and an investment advisor. Uh, Great asset protection. So once assets are in trust for 2 years, they really become bulletproof for creditors and for wealthy families or for families that maybe are working in high risk industries, say real estate or a doctor, being able to protect your assets in case, God forbid, one day something goes off the rails, those assets would be protected. Great privacy. The big one there for our clients is, most states at the age of 18, you need to notify the beneficiary of the existence of a trust. They're entitled to get a copy of the trust and statement. So you can imagine, 18-year-old kid going off to college finds out they're the beneficiary of a $5, $10, $100 million trust. It's sort of a great way to stifle their ambition. And South Dakota is silent as to that. So for our high net worth, ultra high worth families, that's really a huge, huge benefit. So those are sort of the big ones that are out there. And that just give your audience sort of a quick on size of the industry. I mean, South Dakota today has more bank and trust assets than any other state in the country by a factor of 2. So it actually dwarfs Delaware. There's over 60 public trust companies in South Dakota and an additional, I think, 60 private trust companies. So it's become a huge industry, and with its progressive trust law, it just continues to grow and grow.
Yeah. Yeah. I love this. And I think all of those things you stated are fantastic. And one thing that we're starting to see too is some of the incomplete non-grantor trusts, the concept of I can be living in a high tax state, high income tax state like California, New York, that type of thing. Yep. I can create my trust in South Dakota. And let's say I've got $100 million of investment assets that are kicking off really nice income. And I'm tired of giving, pretty good percentage of that to the state in the form of tax. So I can situs that trust in South Dakota, and now I've eliminated my state income tax liability on that $100 million and the capital gains and the dividends that it's kicking off. How aggressively are some of those states? Are they trying to come after that income, or is that pretty well buttoned up with case law that there's not much they can do when those assets leave?
Well, case law is pretty solid, but I would say probably the most aggressive state out there right now is California. I mean, they really try to have their hooks into everything. I mean, if there's co-trustees serving in California, or even a protector, it kicks the trust into the California tax system. So all the benefits you try to reap aren't out there. So, the key is really getting it structured correctly to get everything out of California and whatnot to really protect that income from the California state income tax.
Yeah, I love this. Antony, you talked about co-trustees and some of those other things. So that sort of leads us into this discussion about a trustee in general. Can you give us an overview of why Sterling Trustee versus a family member or a local bank or something along those lines?
Sure. So, if you were to compare us, Sterling Trustees, as an independent corporate trustee versus an individual trustee, I think the big thing is a lot of family members are honored to be chosen to be the trustee. And, what they don't realize is the fiduciary risk and legal risk that they're taking on in order to serve in that role. So you need to have legal knowledge, tax knowledge, investment knowledge, accounting knowledge. And, most of these people don't have it. And, that's where mistakes happen and you get into some huge issues. The other issues that you see is just, it creates family strife, because sometimes I'll name oldest son as the trustee, and now younger brother, younger sister have to go to older brother to get a distribution. And you can imagine, the potential issues that can cause. When you compare us to sort of a bank trust company, I think that the two biggest things really are what I call, there's a conflict of interest between the trustee and the investment advisor. And the way I sort of say it is, if you're at a bank trust company, they're acting as your trustee, your custodian, and investment advisor. And if the investment advisor part of the house is not doing a good job, unlikely the trustee side of the house is going to fire them and move the assets somewhere else. And that's what we do. We work with best of breed financial advisors around the country to do that. The second big issue that you see with the big bank trust companies are what I call distribution bias, where client wants a distribution, they call up, and the bank makes you stand on your head to get the money out, because if they distribute the money out, it lowers their assets under management, which lowers their fees. So That's the other thing that just drives clients crazy. And so, we eliminate that by just charging a fixed fee. So we have no sort of axe to grind in terms of distributions.
Yeah, I love that. And I want to just talk about the fixed fee for just a second, because I look at the industry in general. And when I say the industry, I'm going to call it financial services industry. And we can lump, uh, trustees that have that conflict of interest with managing the assets and also being the trustee into that equation. And there's so many conflicts that are out there. The biggest one that we see is clearly commissions, right? Like it's really hard to know if this product is best for me when there's a commission involved, because my advice is now skewed by my compensation. To a lesser extent, even though when we have, we'll call it assets under management, I'm supposed to be taking a fiduciary responsibility if I'm managing those assets for a fee. There's still conflicts there, right? I can skew my advice to, keeping those assets in the portfolio versus doing things like paying down debt and that type of thing. And so it's like, well, yeah, I'm going to give you the advice. It sounds really good, but it's all going to point to leaving the assets there. I love the fact that you are removing all of that and you're saying, hey, we're charging a flat fixed fee. We're independent of, we don't care who's managing the money. We just want the best performance for you. And we're going to start pulling the levers in a way that are going to comply with the documents that were created, the wishes of the grantors, and make sure that everything is going well. We do things very similarly. We think a flat fee makes sense. And so those are, I think, just really important highlights that most people will gloss over.
Sure.
And then all of a sudden their administration's not going the way they want. And they're like, what's happening here? It's like, well, oh, I see your financial incentives are misaligned with what we want to have done. So I think that's great. Good. Anything else on,
Look,
because
I'd say two things on the fees. One is, listen, at the end of the day, I'm really providing fixed administrative service. I'm not making the assets go up and down. Hopefully we're working with good investment advisors that are doing that. So, I don't think I deserve to be paid on a AUM basis if I'm just providing an administrative service. And then, listen, the same thing goes sort of in your industry. If you're managing $5 million versus $10 million, I mean, are you doing anything more to do that than, two different amounts? Probably not. Maybe you're taking on a little more risk just because of the size, or one could go wrong. So I sort of agree there. And, I think that, the benefit of having us is we're going to look over the shoulders of the investment advisor. And if they are putting the client into products that have high fees, let's just say it's a large cap ETF that's charging 20 basis points when you can get the same one for 5 basis points, we're going to call them out on that. Look after the client. I mean, that's what we're getting paid to do.
Yeah, absolutely. And you also touched on a key point around family being involved as a trustee. We've seen family suing each other when they weren't necessarily trustee. They're inheriting business assets, and it's just a mess. And so we've seen $250,000 spent on legal fees suing one another in a family, and it's like, okay, this is not what anybody wanted out of this scenario. And so keeping family out of the mix, I think, is a very wise move, especially when assets are. The only time I've seen it work out when there was about $1,000 left, and they have a pizza party every year. That's all there is. Like there's not a lot of money to administer. Like that works well. That works. But other than that, I think once the dollars start getting real, people's interest starts conflicting. So, and you also touched on the liability, right? Can you talk a little bit about how important it is to have bonded trustees and sort of everybody on the team being bonded?
Yeah, absolutely. I mean, listen, that's the number one risk in our business is, making an error or admission or whatever it is. And we're insured through the wazoo between director's insurance, errors and omissions, cybersecurity insurance, all that kind of stuff that, an individual that's serving typically doesn't have. And so, when they make an error, they might have to end up going into their bank account to make a beneficiary whole if they make a bad decision where, we're protected and, but we have the systems and whatnot in place to be able to manage the fiduciary risk and the regulatory risk, where again, individual really doesn't have any of that and just doesn't have the knowledge or the skills.
Yep. This is This is great. And I think uh, one thing I'm curious about is, let's say somebody's got a trust, it's set up and they've got a trustee and they've got some of the problems we've been talking about. Their, uncle's managing it, or there's a bank. How do we go about, like, if we say this all sounds great, how do we go about transferring that to Sterling? Is there
Sure.
a process to do that?
Yeah. So it sort of happens one of two ways. Generally, if the trust has been drafted well, there'll be language within the trust document to be able to change trustees and change the situs of the trust. The situs is the jurisdiction that governs the trust law. So, in our case, South Dakota. So, if the trust has been drafted well, there'll be language in there to make those changes. So it should be, relatively straightforward. You just need to follow the language within the trust document to make that happen. If you don't have that capability, the other thing you can do is what's called a decanting, where basically you set up a mirror of the existing trust. Let's say that trust is in New York or California.
Mm-hmm.
You can set up the exact same trust in South Dakota, so it changes the governing law and the trustees, and then you pour the assets over from the existing trust into this new trust, and off you go. Unfortunately, you're going to have some legal expenses in doing that, but on the plus side, take California, for example, you're not going to pay any state income tax or capital gains tax on any sales or capital gains in the trust. So, the payback on this is, really quick.
Mm-hmm. Right. Absolutely. I think that's great. And I also think, just as encouragement to our listeners, all the legal teams we work with are really good at building these trusts and building in some flexibility, just knowing that, the estate tax law has changed. You might want to make adjustments over time. And so we think that's a key piece to designing a trust. We joke a little bit about people's estate plans. They usually have three. There's the one they want, the one they think they have, and the one they actually have. And we try to keep those updated and make sure almost every 5 years or a life event is kind of a good review schedule to make sure that everything's staying on track. So, all right, Antony, this has been great so far. So let's say I'm thinking about putting together a trust. I'm at the point in my life and my business and my career that I'm going, okay, we've accumulated some significant assets. I love all the benefits that South Dakota offers. What would be a good first step to get that process going?
Listen, we're happy to field those calls and give the clients guidance as to what to do. We can refer them to attorneys that work in South Dakota or know South Dakota law and licensed in South Dakota law, so that they can draft the trust. Or the other step is if the client has an existing relationship with a trust and estate attorney, tell them, listen, I want to create a South Dakota trust as part of my estate. And, if the trust and estate attorneys, worth their weight in gold, they'll help them and agree with them to make that happen. If that attorney is not licensed in South Dakota, there's a whole cadre of attorneys in South Dakota that all they do is help out-of-state attorneys move trusts into South Dakota. They charge maybe $1,000 to do it. They'll just basically review the work that the existing trust and estate attorney has done to make sure it conforms, and, off you go. So it really just depends on the relationship, but, we're here to provide clients with that advice and get them going in the right direction if they'd like to speak to us.
Yeah, no, I think that's great. And I love the fact that when we think about all the decisions that maybe need to come through the process of building our trust, I think starting with Sterling and having sort of that check box crossed off for trustee, like, okay, I don't have to think about that, is fantastic. So, and I also want to encourage our listeners too. So my dad was a small town attorney, definitely did some estate planning, but also did lots of other planning, would do everything from set up some legal entities to, there might be some divorce, real estate closings, did a little bit of everything. From our point of view, we like working with attorneys that are really good at estate planning. It's all they do. They're not dabbling in these other things. If their firm does those other things, it's handled by different advisors, because we think the complexity that comes with building trust and all the different types of trust out there, somebody needs to be on that, and they need to be doing it regularly. And our preference would be, and this happens regularly to our clients, their legal counsel that they've used for some of their, entity documents and that type of thing is really good at that. And they can probably do some estate planning, but they're not used to doing the level of estate planning that our clients need. They might be the wealthiest client they deal with. And we would like to just make sure, Anthony, you touched on this, call Sterling and you will put them in touch with somebody that's really good. You don't have any financial incentive to steer them any other direction than get them great outcomes. And so I think that's great. We do the same thing for our clients. We have no financial incentive to refer you to one attorney versus another. We just want the best outcomes. And the nice thing about the work we're doing, we think, I'm in Iowa. South Dakota's a neighbor. We've got some firms that are right on the Iowa South Dakota border that do great work. And I think from my point of view, the Midwest pricing is really good. You get out in California and New York, and even we've seen some, Dallas, Texas attorneys, they get expensive. And so it's nice that we can get some of this work done for lower cost. So that's just my, general disclaimer for just find super qualified counsel, and you might pay a little more to get the work done, but it's going to be done well. And an ounce of prevention is worth a pound of cure. So
I think the beauty of our models, listen, we're focused on being a trustee. That's what we know how to do. Just like you are focused on the planning and investment side, work with a trust and estate attorney that's just focused on that. Because you go to a smaller town lawyer that maybe dabbles in a whole bunch of different things. Listen, today, unfortunately, in the legal practice, a lot of these documents are just computer driven. They're filling in names, addresses, phone numbers, and, they're off to the next trust. And, unfortunately, you as a client who doesn't really understand some of this stuff doesn't know any better. And long term, that's where you potentially could get caught in a bad situation.
Yeah, absolutely. And it's shocking. We're reviewing trust and estate documents regularly. And just today we had a meeting with a client, and we've got one of our advisors on our team is an attorney. He's not a practicing attorney, but he's got a legal background. And he was reviewing their documents, and they're so long. You don't typically, the clients typically don't read them. But there was a surprising number of errors in the documents. They were very administrative, but you can tell that this is done as a form, and they're just, for lack of a better term, search and replacing some of these things. And so, having a second set of eyes, take a look at these things, and qualified counsel that really knows what they're doing is really important. So, I love that. Okay. So let's see. Somebody calls Sterling, you get them pointed in the right direction. They start to get their trust documents put together. Can you talk us through what it looks like to have a relationship with Sterling, and just the value you're providing on a regular basis for administering the trust?
Yeah. So, once the trust document is sort of complete, signed, ready to go, we'll onboard the family. Basically, we need the trust document. We're going to need all the KYC information as to the source of wealth and where all this came from and whatnot. Sort of just basic stuff that, you as an investment advisor do as well. Once we have all that information on board, typically we'll sit down with the family and the investment advisor. And if we're, going to be the trustee and have purview over investments, typically we'll sit down, put together an investment policy statement. So it becomes sort of the, I don't want to say grading sheet, I guess, for the advisor on a quarterly basis. We'll put together the asset allocation, and then, the investment advisor will fill it in with what they think are the best means to, get returns in those asset classes. And then typically we're getting on the phone with the family and the investment advisor on a quarterly basis to review the portfolio, see how things are going, check it against the investment policy statement to make sure that things sort of aren't out of bounds. And you kind of rinse and repeat, rebalance. And we find if you get into this sort of quarterly cycle, it really is helpful, A, for the families to get to know us and understand what's going on, but B, also for family members that maybe are younger and aren't as experienced in the investment world. This is a great way to get, sort of clued into how this works and understand what's going on. So, one day, maybe when your parents aren't here, you're in a position to be able to take over and whatnot. Mm-hmm. And then typically once a year, we like to get together with the family face to face and, whether it's having a meal or whatnot. But really try to understand what their issues are and what's going on with the family dynamics, so that if we have to make a distribution decision, we feel like we have full information to be able to do that.
Hmm.
And, I can't
Yeah.
underestimate, how important that is in terms of, risk when you're trying to make those
Yeah.
decisions.
Yeah. Yeah. No, I think that's great. You mentioned KYC, which is know your client.
Yep. Sorry. Yeah.
No, that's great. And I think you're doing a great job of that. And, really KYC is all around like money laundering. You make sure you know where the money's coming from and who these people are and that type of thing. And I think it's great that you're going, okay, let us understand you and your thinking and your thought process. And now, again, it just helps with serving the client well, helps reduce some of that liability piece that's hanging out there. And you brought up an interesting point about investment policy statement. We love an investment policy statement for our clients, especially dealing with the entrepreneur. They've got lots of unique investments, right? They might have a real estate portfolio. They've got a business that is probably the majority of their wealth, but they also come across all these unique opportunities that are private opportunities to make investments, might be moonshot type deals. And so I'm thinking about this and I find it interesting. We see the entrepreneur likes the entrepreneur pathway. And so like, hey, I could see, creating some piece of my assets that will support the next generation starting their own thing. So do you see that coming into investment policy statements? Like, hey, we'd like to take 10% of our assets or 20% of our assets or some dollar figure that if somebody wants to start a business, they need to create a business plan. And, is that something you guys are seeing regularly? You're reviewing, going, all right, yeah, does this make sense to make this loan to this family member? Yeah, I'm just generally curious about that.
Yeah, typically we don't see it in the investment policy statements, but we typically will see it in the trust document in sort of the dispositive provisions, which means these are the provisions within the trust that tells you how you are allowed to make distributions. And so there may be language in there to that effect, like, I want the trustees to consider, for my son, giving him a loan to start a business if he's got a business plan or whatever it might be. So, if the trust document is well thought out, a lot of that language should be in there to sort of take care of that.
Yeah. Hey, real quick, if this conversation is getting your wheels turning and you're realizing there might be some opportunities you're missing out on, I want to invite you to check out vitalstrategies.com/tax, where we can discuss advanced strategies specifically for entrepreneurs who want to reduce taxes, protect wealth, and structure their finances more intentionally. Whether you're already using trust or just getting started with your estate plan, we'll help you find the right strategies that can help you move the needle. Again, that's vitalstrategies.com/tax. Now back to the show. So far, our steps are, if you're thinking about putting your trust together, even if you have your trust, get in touch with Sterling and figure out how they can be involved as trustee. And then, we're building a plan around the trust by getting connected to solid legal counsel that understands how to build a trust in South Dakota. And then we figured out what the administration looks like. We're having quarterly meetings. We've created our investment policy statement. Is there anything else from a setup and structure point of view that you think is a critical part of that process that we also need to talk about?
Yeah, no, that's a good question. I would say the number one thing that I see is really, in order for the trust to be successful and for beneficiaries to hopefully benefit in a way that doesn't sort of stifle their ambition and whatnot, it really comes down to the parents and sort of the values that they instill in their kids as young kids in terms of how they look at money, how they respect money, and so forth. If those skills aren't taught at a young age, everything sort of goes off the rails. And that's where my psychiatry piece comes into play in terms of, dealing with beneficiaries and having to tell them why, taking $1 million out of the trust for a Lamborghini is just not going to work. So I think really the key is on the parents and, trying to teach them good values, learning how to do chores, getting an allowance. All those sort of things have a monumental impact on, the kid's ability to deal with money long-term and respect it, so that, even though they might have a trust that they're going to benefit on, how can their kids benefit as well, going down the line so that everybody can
Yeah.
benefit long term.
Yeah, no, I love that. That's fantastic, and that's something we really spend some time with our clients when they're they're trying to create these trusts. It's like, all right, let's really think about core values and things want your family to know and understand, and let's get these things built into our DNA early, because there's some really interesting research out there that. I got this from a book called The Comfort Crisis, and it doesn't matter whether you have $1 billion in your trust fund that's supporting you, or you're sort of the average Joe. Like, we find a way to create stress in our lives. We look at it, money is thinking it will solve all of the problems. It just creates a whole different set of problems. And so I think keeping that in mind, most people think, oh, if I just had more money, life would be better. And that is not always the case. So if you can instill that in your kids early, that like, this money is just a tool. It's not going to make it can make your life comfortable, but it's not going to make it significantly better. There's all sorts of data. It says above a certain threshold, it really doesn't increase our happiness. So that's great. I appreciate that. So now I'd like to maybe shift a little bit and just talk about things that you see done poorly, maybe so we can give our clients and listeners if there's things that go into trust that you're like, man, we've seen this, we didn't realize that was going to be a problem, or the client didn't realize it's going to be a problem. But when it comes to administering this thing, it really, really is a challenge. So is there anything along those lines that you see that, maybe come across your plate? My guess is you probably see all sorts of different types of trusts and creation setups, and some probably work better than others. So is there anything that comes to mind there?
Yeah, a couple of things. One, really is on the trust creation part, and really, maybe 20, 30, 40 years ago, I mean, trust documents were written, they would write in Bank of America, for example, as the trustee, and there was no way to remove them and whatnot. And, when you were picking a trustee, it almost became like a life decision you were making. Mm-hmm. Really today, if, the trust and estate attorney, and this goes back to the conversation we had around, employing a good trust and estate attorney, you want to make sure you build flexibility into the trust so that there's the ability to remove the trustees, the ability to change the status of the trust. So you can, if you want to move it to another state or whatnot, you have that capability. I think the other thing that families should think about, a lot of trusts have sort of age dates. And what I mean by that is, once the child reaches 25, 1/3 of the trust can be distributed out, and 50, another third, and so forth. And again, that's a personal decision on the family side. But, one of the things that families don't think about is what happens if your kid gets divorced and, a distribution gets made, and, all of a sudden next day they get divorced, half of that money disappears. So, sometimes leaving that to the discretion of the trustee, really can protect the kids long-term in terms of asset protection. And so those are some things to sort of think about.
Yeah. No, I absolutely agree with that. We talk so much about, what is the life cycle of this trust, right? Like we could start to distribute it, but we don't see a whole lot of benefit to that. We see the creditor protection of the trust being so valuable, and the number one creditor out there is a divorcing spouse. And so it's like, why not just leave it in the trust? You can enjoy all of the benefits of those assets without having to own them personally. And same thing's true if I'm driving down the road and I run into a school bus full of lawyers' kids. It's like I'm better off leaving those assets in the trust, especially the South Dakota trust. It's got privacy, it's got incredible creditor protection, all of those things, versus having it in my own name and exposed to that liability. So,
I mean, listen, it's a tough decision for parents. I mean, some parents listen, like, they don't want to rule from the grave and feel bad. They're like, listen, I've enjoyed my life. I'm leaving this money to this kids. Hopefully they'll take care of it. And if not, it's not my problem. I'm dead. But they don't think through the ramifications of what that does long term to the family. And for all the various things that we've, already stated here. But
Yeah.
but I think really the key at the end of the day is making sure that the trust is well drafted. There's flexibility. And one of the other things that's really important is one of the other roles in a trust document is the role of the protector. A protector is like a
Yeah.
super fiduciary, and basically the power of the protector is to really be able to fire the trustee at will. So if we're not doing a good job, we should be able to be removed easily as well, so that you have, sort of protector looking over my shoulders as I'm
Yeah.
potentially looking over the shoulders of the investment advisor, and then you've got an independent custodian. So you have sort of accountability all the way down the line. You've got good separation of duties, and it really is the best model long term for the family.
Yeah, yeah, no, thank you for bringing up Trust Protector. When you were talking about flexibility, that was something that I was thinking of, because I'm going to identify what I believe, a Trust Protector role is, and I know just enough to be dangerous, so please feel free to correct anything that I say. A Trust Protector is there to really do like you said. Okay, if the trustee's not performing their job the way we think they should, let's, we can replace them. But I think their role is much bigger than that. They can also look at changes that are taking place in the legal, I don't know, cultural landscapes and go, okay, these things now don't apply to this trust, and we need to make some adjustments. And so we're going to do some of those things. Is that a fair assessment? Is that?
Yeah, no, I listen, you can give a protector a lot of different powers. I mean, sort of the most general is the ability to hire and fire, but I mean, you can also give them the ability to approve a distribution with a trustee. So you've got a, sort of a second opinion on that. They could also review investments and all sorts of things, and then also make legal decisions as to, all right, maybe we need to decant this to another state, or change language if it's an administrative language decision that can be changed. So yeah, I mean, it just gives the family a lot of flexibility when, you can disperse those roles to keep sort of everybody honest, for lack of a better word.
Yeah. And would a Trust Protector generally be like a law firm? Who's going to fit in that role? I know it could be my uncle, but yeah, is there
Yeah, I mean,
somebody that generally
typically,
feels like?
you want somebody that's familiar with trust and has some legal knowledge and whatnot. So typically you do see, lawyers serving in that role. It could be a family member that maybe is in the financial services business that understands all this stuff. So, you really do need somebody that's knowledgeable, but, a lot of times it is a family member or a beneficiary that, serves in that role, for better or for worse, just to have sort of better control over the trust. But I think, picking somebody that's got knowledge, you want to pick somebody that's going to be around. A lot of people, they set up a trust when they're 50, 60 years old. They're picking their lawyer who's the same age. And, when they die, the protector's getting ready to die. So you want to make sure you've got somebody young, or you've got a succession plan in place to replace that person with somebody younger that, so you have that continuity going forward.
Absolutely. And I think that goes back to our review process. We like looking at those every 5 years and go, hey, because it's so tempting to go, you know what, I'm going to put my brother into these roles, well, guess what? Your brother's probably close to the same age you are, and he might not be in a position to, make any of these decisions. So it's like, it might work now when I'm in my 40s. If something happens to me, my brother can make those decisions. But long term, that's not a viable solution. Right. And so I think making those fine tuning adjustments, we like to talk about estate planning as a motion picture as compared to a photograph. Yeah. It's not a one and done. It's like, it's going to be constantly changing, and we just need to keep evolving as time goes on. So
that's exactly right. And listen, that's one of the biggest issues with a individual trustee is the aging out. And as you said, you set up the trust at 40, nothing really to be done. But when they die at 85, they're also going to be 85 or 80 or whatnot, and right. Now you've got a problem. That's where having a regulated corporate trustee eliminates that problem.
Yeah. No, this is great. Now, I think about the benefits of a trust. We haven't spent a lot of time talking about that, but I think there's so many that it almost is. Once you get above a certain threshold, it's almost unimaginable that you don't have a trust, right? Because the benefits are outweighing the downside. Now, there also is a level of I don't know, I'm going to call it planning tolerance. You can create a super complex trust structure that goes on for, eternity, right? Like put up one in South Dakota and you can have this thing run together forever. You can also create tons of creditor protection, and you can move it out of your state, the state you live in, right? But all that is somewhat of a burden. But I think as our wealth grows, we should really consider like layers to this process. In my mind, we get over $1 million net worth. We need, probably a revocable trust and the standard will documents. And then we start looking at, okay, that'll probably do us until we get to the point where we're going to have an estate tax problem. Now we should start looking at irrevocable trust. So our assets can go in there and we can sort of freeze or discount that estate tax issue. And then we could look at charitable opportunities and all of those other things, the trust can really come into play. But we've done a lot of math for clients that have, got businesses worth $100, $200 million. And, getting those assets moved into trust as that business is growing, there's some discounting that can be done, but it can save, the estate tax is 40%. So on everything over the exemption amount, which right now is, I don't know it off the top of my head, 20 some million dollars for married couples. If we're at $70 million at 40%, there's $28 million that I just paid in estate tax. Yeah. And it's like that number makes me want to throw up.
Yeah. We generation skipping tax potentially later down the line.
Mm-hmm. Yes. And then there could be estate tax on top of that. And so it's like, we just believe that the estate tax is the only voluntary tax. You can, with enough time, you can plan around that tax. And so we think it's something that people should start addressing. And if you don't have a plan in place, call Antony and Sterling and sort of get that process going. Call our office. We're happy to get that going for you. But there's just tremendous benefits for having trust. And then we're going to go back to the things you initially talked about. You've got control over those assets. They're not getting probated. They're not becoming public. There's creditor protection. There's the list goes on and on. We could probably have 3 or 4 more podcasts talking about all the benefits of creating a trust. But the short answer is, like, if you want to get that process started, get in touch with Antony and their team, and they'll help you get going. So good. Anything else that we should be talking about in regards to building or structuring our trust?
I think we've done a pretty good job, covering it. I mean, I think, the hardest part is just getting off the dime and doing it. I think a lot of families they get distracted. It's not something they really want to talk about with their families or their wives or whatever. And, so it just gets put off and put off and put off. And, meantime, you're accumulating wealth, and then you potentially tip yourself over into an estate tax situation. And now you've just created a problem, needlessly. And so, I think the key is really get it done early. Look at it every year. So, if you need to make changes and update. But, if you're a successful professional in creating wealth, or, you're an entrepreneur, or you're in a business where maybe you're getting stock options or equity, and, the business starts doing well, and all of a sudden, you've got pretty big equity stake there. The key is do it early and get off the dime.
Yeah. No, absolutely. And Anthony, I also want to just touch briefly on, you guys are also very proactive on the software side of things. You've developed some software to help you just administer the trust. And I appreciate that too. So much of our industry feels like it's left in the Stone Age, with paper files and, sending out faxes. And it's like, who's doing that anymore? So I don't know if there's anything you want to touch on that side, but I just want to acknowledge that as well.
And I think unfortunately, the trust industry is sort of the ugly redheaded stepchild of the financial services industry. I think we're sort of way behind in technology and whatnot. And, a lot of trust companies today are just completely unautomated, paper driven. And, with these complex structures, if you don't bring technology to bear, you really can get your handed to you pretty quickly with all the fiduciary and regulatory risks that you need to manage. And I think bringing technology to bear, allows you to do that. So we've created an app that actually sits on top of Salesforce that really automates a lot of our trust officers' activities, so that, we can spend more time with our clients understanding what their issues are versus shuffling papers back at the office, trying to document it all. I think that's the key to be able to grow successfully in this business and service your clients well.
Yeah, I love it. I love it. So if somebody wants to connect with you, there's the contact page on your website. We've got your phone number, email. There's all sorts of different ways. Is that the best way to really reach out, however people prefer, if they want to connect in person on the phone or via email? Is that the best way?
No, go to our website. We've got a great website. There's a lot of information on there regarding types of trusts, why South Dakota is a great place to be. And so you can learn a lot on there. We've done a lot of white papers and whatnot. So our website is sterlingtrustees.com. Again, sterlingtrustees.com. And, you can contact me directly at 610-234-0626. Again, 610-234-0626. And, happy to have a conversation because this is not an area that a lot of people feel comfortable with. And, that's what we're here to do is really try to hopefully relieve some of that anxiety and get you going in the right direction.
I love it. We'll have all of that information in the show notes. And yes, I've spent a fair amount of time on sterlingtrustees.com's website. Just there's videos, white papers. We'll have links to all of that in the show notes as well. So if you want to check that out, go spend some time there. It's a great resource to just learn more about the process. But yeah, if you're ready to get started in this process, reach out to Antony and their team, and they will get you going. And I just think about what success looks like, right? There's almost no downside. There's a little bit of cost to set up our trust, but it creates creditor protection, anonymity, makes the estate administration process seamless. You don't pay, in the state of Iowa, you pay an attorney 2% to probate an estate. So if you've got, a $5 million estate, there's $100,000 that you just paid out to an attorney to probate that. And so that doesn't make any sense from our point of view. We think you should spend less than that getting your estate documents all set up and done. And it's just a win all the way around. And if you don't, we look at, there could be fighting with the family. We just were talking about that family that was suing each other for $250,000, It eliminates all of those pieces. It keeps all your information private. It keeps your goals and objectives, and keeping the money in the family, line forever if you want it that way. So it just makes sense on so many fronts. And I just think about all the work that our entrepreneur clients put into building this wealth. We hate to see it, paid out to excess fees, attorneys, fighting family members, all of those things. So estate tax, that all is just not good. So we think setting up a trust is a critical piece. So Antony, I appreciate you taking the time and just giving us lots of wisdom and insight into the trust administration process.
Yeah. Thanks for having me on today.
Thanks so much for tuning into this episode of the Vital Wealth Strategies podcast. I hope you found this conversation with Anthony Joffe as valuable and eye-opening as I did. Trust can be a game changer, not just for preserving wealth, but for creating real clarity and control over your financial legacy. If this episode helped you think differently about your estate or sparked some ideas for your business, please take a second to share it with a friend, a client, or someone in your network who could benefit from it too. And don't forget to check out vitalstrategies.com/tax for advanced tax strategies, resources, and ways to get started on building your own wealth strategy today. And remember, you're a vital entrepreneur. You're vital because you're the backbone of our economy, creating opportunities, driving growth, and making an impact. You're vital to your family, creating abundance in every aspect of life. And you're vital to me because you're committed to growing your wealth, leading with purpose, and creating something truly great. Thank you for being a part of this incredible community of vital entrepreneurs. I appreciate you, and I look forward to having you back here next time on the Vital Wealth Strategies podcast, where we help entrepreneurs minimize their taxes, master wealth, and optimize their lives. Until then, keep going, keep building, and stay vital.